joined now by Richard Clarida. He is PIMCO's global strategic advisor. He's also co-head of PIMCO's official institutions channel, which oversees coverage of the firm's central bank and sovereign wealth fund clients. He's also served as Assistant Treasury Secretary for Economic Policy. So we are counting on your perspective here today. You just heard Callie speaking with one of the traders on the floor there, talking about what he characterized as momentum trading, a lot of technicals in there. He blamed it on some of that momentum. What are you seeing in today's marketplace?
Well, there's momentum, but there are fundamentals, and I think the markets are reacting to some really pretty significant negative fundamentals, whether you look at the geopolitical issues in Asia, you look at the enormous challenges facing Europe right now. So, yeah, there's momentum. There's always momentum in market, but certainly there's a range of fundamentals now that are really being felt across all markets.
One of those ways to gauge risk that's widely watched is LIBOR, specifically LIBOR OIS spreads. We had Greg Peters of Morgan Stanley on with us today, and he said that, yes, there's some bubbling up of stress there, but it's nowhere near where we were at crisis levels, and perhaps a lot of this concern might be overdone at this point. What do you think?
Well, I think that is correct. The LIBOR spread, which is basically indicating concerns about bank credit, is wide. It's certainly much less wide than it was 2 or 3 years ago, but it's starting to move in the wrong direction. So I think that that's an indicator. Time will tell if it's a false indicator, but certainly I think that the real focus is now in Europe when it appears that the exposure of large European banks to Greece and to some of the other periphery credits is significant, and I think that's what's concerning markets right now.
Is a double dip in the U.S. on your mind?
I don't think it's the most likely scenario. I don't think it's what's going to happen, but I wouldn't rule it out. I think the most likely scenario is a return to pretty modest growth of around 2% once the stimulus wears off. But certainly I wouldn't rule out a double dip, but I don't see it.
What changed within the past few weeks? We knew that the European financial institutions had exposure to debt and the possibility of default. Why does it seem to matter now that we're seeing some Spanish financial institutions experience some issues?
It's an excellent point, and something really did change, because until about a month ago, the view in the markets was that this was really a liquidity crisis in Greece and maybe Portugal, and the psychology of the market has now shifted to thinking of it really as potentially a solvency crisis. So you can't print your way out of a solvency crisis, and if really Greece and Portugal are unable or unwilling to pay their debts, then it becomes much more serious. And ironically, the size of the package that the Europeans put together, by some estimates nearly $1 trillion, if anything, drew the market's attention to how big the hole was. So in some ways it boomeranged.
It was supposed to be the bazooka, though, that answered that.
The bazooka into the boomerang, yes.
Exactly. But, I mean, your point's well taken. You can't solve a debt crisis with more debt, right? But at the same time, I mean, are you saying definitively here that Europe has mishandled its crisis?
No, I'm not. I think it's a difficult circumstance, and I think that to preserve the euro, I think it was probably appropriate to go in with this size of package. But I think the challenge that Europe faces is that, especially for the euro, there's no mechanism within the euro for a country to leave or to exit. It's sort of like the Hotel California. You can check out, but you can never leave. And I think the markets know that at some point Greece may have to exit the euro.
Why would they do that? The point has been made to me. Their debt's still going to be priced in euros. If they leave and take the drachma, their debt's still going to be more expensive.
And you're exactly right, so long as it's just a liquidity issue. But if they're truly unable to repay, it really doesn't matter. If you're going to default, you're going to default.
Do you believe that we are pricing in a default at this point?
I think essentially that's the way to interpret the price of Greek debt right now. It's pricing in a high likelihood of a default or a rescheduling scenario.
What are you hearing the most from your clients right now? You talk to central banks, sovereign wealth funds. Fear is begetting fear, some say.
Yeah, and indeed this was the subject on my recent trips, and particularly interpreting the developments in Europe and whether or not they need to rethink their view about the euro and the euro area. So that's definitely on their mind right now.
Richard, you were saying that $1 trillion European package was more of a boomerang than a bazooka. What's next? Do you expect Europe to act again and intervene here in the markets?
I don't expect it, but obviously you can't rule anything out. There's some speculation that there may be currency intervention, that the ECB may engineer an emergency rate cut. Indeed, that was on the wires this morning as a rumor. So obviously other policy tools are available. I think part of what's happening, Margaret, is that some of the key details in this $1 trillion package have really not been worked out. And I think that needs to occur at some point or another. And again, we've been getting news just today or in the last couple of days about the balance sheets of some of the big Spanish commercial banks. So, yeah, it's a moving challenge right now.
Well, it's a market rife with rumors, and as you point out, some lack of clarity there. But how do you stop the rumors from perpetuating?
Well, I don't think you stop them until you basically get everything out on the table in terms of bank balance sheets.
What is it that the market needs to know?
Well, I think for some time there's been a view that commercial banks in Europe have not been as quick as U.S. banks were to recognize losses. And indeed, there's been some BIS and IMF reports to that effect. So to the extent that people are concerned about the other shoe to drop, as we like to say, or don't like to say,
I mean, how many shoes are out there at
well,
this point?
I tell you, it's a big closet,
How
right?
many feet we
Imelda Marcos, right? Thousands of shoes out there.